Okay.
Okay. Now you can start.
Okay. Am I audible perfectly?
Yeah, not an issue.
Okay. So, good afternoon, everyone. Today we are here to discuss the faults in the financial statement. There are times where balance sheets have faults which we are not able to virtually see. They need to be identified. So today we'll explore some strategies and indicators for detecting the issues, and along with we'll look at some real life examples to illustrate this faults. Financial statements basically are backbone of company's financial health, and they provide a great insight to the performance and stability of the entire company. There are times where these are, however, not accurate and are window dressed to inflate the profits or to complete their aim. So today we'll look into some common manipulation that usually occur in the financial statements, and then we'll learn how to detect these manipulations effectively. So commonly there are four main tactics which company use to window dress their financial statements. One of the major manipulation technique is revenue recognition. Companies record fictitious sales or expenses which are not even incurred to inflate their profits. And then comes expense capitalization. Their operating expenses are wrongly classified as capital expenses. And in finance world, capital expenses are usually considered a positive indicator and therefore artificially boosting profits. Then offset balance sheet items provide hiding liabilities of the balance sheet or misleading stakeholders who are not actively involved in the preparation of financial statements or day-to-day running of the business. And lastly, related party transaction. Related party transactions in generally are not a bad thing, but there are times where these occur at non-arm's length deals and can distort the financial state of a company. Therefore, very important significance is given to the related party transaction, and have companies have to follow certain reporting guidelines when it comes to related party transactions. So we'll first talk about indicators of fault in financial statements. And while actually looking into the indicators, we need to compare usually 4 to 5 years of data to actually know about the trends. We can't just compare this year with the previous year and get the complete insight. First in the line is unusual changes. There are at times where there are sudden spikes or drops in assets or liabilities, which can be a negative indicator usually. Then comes the inconsistent financial ratios. Financial ratios are always mentioned in the note section for the financial statement in the report. Then is the misalignment with the cash flow. Here, reported income does not match with the cash flow from operations. This can suggest possible manipulation, as cash flow statements are really difficult to manipulate as compared to the financial statements like profit and loss statement or balance sheet. Also, frequently non-recurring items, if they are occurring regularly, they are a major red flag. So first first example, this is the glimpse of the balance sheet of Vodafone Idea Limited. So this is from March 2013 to March 2024. By comparing with the previous year, we can see there is a major inflation in the borrowings over the year. And along with there is a decrease in the reserves, which is usually a negative sign. So manipulations can be identified. There are various techniques that can be used over the time. First one is ratio analysis. Ratio analysis is really essential and it allows us to spot inconsistency over the time. There are some ideal ratios that are way more reliable And then is the trend analysis. We compare the financial trends with the industry benchmarks. We can identify anomalies with the current company. Also, the discrepancies with the income statement, balance sheet, cash flow statements can reveal a lot information. People often do this mistake that they only study the balance sheet or profit and loss while studying the financial statements and ignore cash flow statement, which is often a really significant mistake that people do. Lastly, reviewing footnotes and disclosure is crucial for uncovering hidden or obscure information that might indicate manipulations or major events that took place recently, but that are not directly affecting the financial statements, though they are not in the financial statements. So as I said, ratio analysis is a really important. So we can understand many things about the company. And this is a glimpse of the ratios for Reliance Industries Limited for financial year 2023. Ratio analysis can be always found in the financial statements. So here there are mentioned current ratio, debt equity ratio, debt service coverage ratios, and much more. These are cited by Companies Act 2013 as they are compulsory. Also, the major variations that are about 25%, they have to be cited with the reasons. As you can see, the debt service coverage ratio has been changed by about 70%. And along with trade receivable turnover ratio, return on capital employed. So these are cited with the reasons. Data along with its own previous year is often not sufficient at times. We need to compare it with other industries of the same sectors. So this is a glimpse of the major players of the telecommunication sector. It can be really helpful in knowing if a particular company is doing good with comparison to its industry standards or not. Here we can see the major players. If we take Vodafone Idea, for example, its return on capital employed is really low with comparison to other players. Similarly, dividend, market price, profit is really significantly low. So as I said previously, cash flow is really hard to manipulate as compared to net profits or balance sheets. Usually there is a difference between cash flow from operating activities and net profit, but it ranges from 10 to 20%. Above it usually becomes a major red flag. Here you can see the net profit has been decreasing constantly, but there is not such trend visible in cash flow from operating activity, which has to be studied thoroughly to know the various reasons. So now comes the classic example of the Satyam computer case. It was a major example of unusual changes in items. It was involved in major scandal when the founders confessed to inflating companies' cash and bank balances. They created fake invoice accounts and significantly distorted their financial statements. This manipulation also led to severe financial and reputational damage, resulting to them losing the market price, market share, and eventually had to disclose everything out. It also highlights the importance of scrutinizing sudden and unexplained changes in the financial items. Next, we will discuss another major example, that was Kingfisher's airline. It resulted in increasing debt to equity ratio rapidly due to mounting debt and poor financial management. It also led to the liquidity issues, and eventually the company had to collapse. The inconsistent financial ratios were a clear indicator of the company's financial trouble. Therefore, it was really important to monitor financial ratios over the time, and they can be really helpful in identifying companies at the risk of financial distress. So as you can see the balance sheet, the equity is constant. The reserves has been dropping majorly. If we'll compare to June 2006 to March 2013, the equity was dropping, reserves were dropping majorly, but at the same time borrowing were inflated exponentially. Ideally, the debt equity ratio shall be 2:1, that is maximum of two parts of debt to one part of equity. This is usually a negative indicator if the debt equity ratio goes more than 2:1, because if situations go worse, there are less chances of debt being paid off completely through equity or the other asset. But here it was not the case. The debt was increasing, soaring high. At the same time, the reserves were not able to cope up with the sudden inflation. The next is misalignment with the cash flow. We'll take another example of Hushan Steel, which is now taken over. It demonstrated misalignment with cash flow in 2014. The company reported significant revenue growth and a large increase in accounts receivable. Also, it indicated that company was not collecting cash effectively. This led to severe cash flow problems, contributing to financial distress. Here, the company has booked assets already ahead of its time, but there were no effective internal controls for the collection of the cash. So eventually it was increasing the trade receivable section, but there was no effective collection of the cash. This exam statements align with cash flow to detect potential manipulation, because here the cash flow was as such not showing the increase, but at the same time the assets were fictitiously increasing. So to effectively scrutinize financial statement, one of the most important procedure is benchmarking. Always we should compare the company's financial metrics with industry peers to identify anomalies. Audit reports should also be reviewed for qualifications and emphasis of matter, as these can highlight potential issues which are not quite visible in the balance sheets or the profit and loss statements. Next, we can assess the strength of internal controls. Internal controls play a major part when it comes to daily running of the company. And lastly, the frequent changes in key management position. They can also indicate potential instability and issues. And beverages in 2018. It faced scrutiny for inadequate disclosures and discrepancies. Now, disclosures and discrepancy are a major significance, which have to be mentioned in the financial statements. And also the resignation of auditors and insufficient transparency. This led to a sharp decline in its stock price. This case highlighted the importance of thoroughly reviewing footnotes and disclosure to uncover potential financial irregularities. So now we'll look into a case of Yes Bank. It is a classic example of governance and management issues. The bank had high levels of non-performing assets that were not adequately disclosed. This lack of transparency led to a crisis of confidence and government bailout to stabilize bank. Strong governance and transparent management. To give you an overview, so basically non-performing assets are advances or loans that were given out by banks that have been overdue for more than 90 days. There needs to be a proper internal control for bank to actually verify who they are giving out loan to when it comes to individuals and businesses. If they have the if they have their basic repayment ability or not, or they are actually having significant collaterals or not. This was a major blunder because loans were given out without proper checking. If without proper checking of the repayment capacity of individuals and business, which led to inflated non-performing assets, which is clearly visible. If we look out to if we compare March 15 to March 2021, there is highly inflated non-performing assets. Over the time, this had to be treated, and it also resulted in a major loss of its market share and its price. So now we'll actually look into the market ratios. Financial ratios are always significant. So ratios can actually give out a lot about how company is performing or not. There are liquidity ratios which actually help to identify the company's ability to repay short-term and long-term obligations. There are current ratios that are current assets divided by current liabilities. This actually ideally shall be 1:1. That is, company can repay its current liabilities with current assets. And then is cash ratio, that is ability to pay off short-term liabilities with cash and cash equivalents, and company does not have to rely on the trade receivables or other investments. Then there is debt equity ratio, that is debt against the shareholders' equity. Then comes the debt service coverage ratios. It reveals how company can easily pay its debt obligations. This need to be studied thoroughly to actually know how the company is performing. Then is inventory turnover ratio. It signifies how much times a company inventory is sold and replaced over a given period. It can be actually significant while for trading companies or manufacturing companies. Then our profitability ratios. They actually measure a company's ability to generate income related to revenue, balance sheet assets, operating costs, and equity. Common ratios are gross margin, return on assets, return on equity ratio. Return of equity measures how effectively company is using its equity to generate profit. Usually, the company does not gives out entire income as a dividend. If the company is in the stability or in the declining phase, then the company usually give out the major earnings as dividend. But if the company is moving towards expansion or growing, then company usually takes decision to not give that much dividend, or at cases it does not even distribute dividend. Rather than uh, it puts the entire earning as retained earning, that is put back into the business for expansion. Then comes the market value ratios, that are book value ratios, dividend, earning per share, price earning ratios. Price earning ratio again is a really significant ratio. It compares the company's share price to its earning per share. It really needs to be in alignment with how the companies perform. So next is the key takeaways that we are going to summarize entire thing. So it is like vigilance is often need to be analyzed thoroughly. Consistency, transparency, and strong internal controls are always essential for accurate financial reporting. we can actually study real life examples and we can understand how to better understand and mitigate risk associated with the financial statements. Also, we can understand the guidelines, how the company is running, and through everything, ratios, benchmarking, ratio analysis, trend analysis, we can learn more how the company is performing and how its financial statements are performed. These are usually available easily and can be analyzed properly. So this was everything. If you have any further questions, you can actually ask.
So anyone has any query or question? It's a critical subject to understand. So more the active participation will give you the more the good result. So if anyone has any query or question or want to do analysis of any other stocks, we can. Amanda, can you stop sharing the screen and come on to the main screen?
Sure.
So in chat section, there is a question for you from
Yeah.
Dr. Tejas. So can you read it and you answer?
So yeah, these are maximum. They are effective because they have often maximum. These systems are actually coded to study the entire system. So it actually does not involve per individual guidance. So they are major part effective, but like a personal touch is often required. So you can rely on them, but you need to actually study the company's financial statements on your own also to get better understanding about it.
Anyone has any doubt or query? Anyone?
Future prospects company.
Yeah.
I just wanted to know, all these financial statement, when all right, everything is fine, then company is going to do good. But in terms of when I want to put my money in some stock, how do I know about the company? They might be, having some problem right now in their financial statements or in their company. But uh, the share price of such company would be low and maybe performing bad. But how do I know the prospects? Maybe like we are talking about uh, Idea, Vodafone, and there is a lot of positivity right now in the market for them that this company is going to be doing good in future. So right now, if you see their financial statements and in everything, it is not looking very nice. But there is a positivity in terms of putting up money, and it is cheap also. And over a period of time, if we see let's next 5 years or 10 years, it looks to be a promising candidate to grow multi-bagger. So how do we select that kind of companies wherein right now it may be showing some the company is in some trouble, so it is valuation is low. And what are those kind of indicators? Are there some kind of leading indicators wherein I can look for these kind of companies?
Okay. So Deepak, see, whenever there is a some positive sense or anything is coming into any stock, The first signal we are
Okay,
normally
so
getting from charts only. Apart from charts, let Tamanna will explain you how we can see other things. Yeah, Tamanna, you can carry on.
okay, so basically there is always a possibility of anomaly that we can actually at times while analyzing we can actually have that the company may appear promising or it may not appearing promising. We can always just follow the trend. Currently, if we take the example of Vodafone Idea, its reserves and surplus are actually getting better, but they are not yet. And uh, while I stated the uh, past trend, I actually did not represent its future condition, what it can be, and what promises it actually can. Of course, it is trying to grow, and in fact, the share price is currently growing. But there are always a chance that how the company's balance sheet, the position it shows, it actually is going to go in that direction only. Because eventually, apart from the fluctuations due to environmental activities, company share price majorly depends on the company's day-to-day functions or how the company is individually doing it. So if we go on that basis, it is actually improving, but still there is a high rumor about its management and how it will actually solve the trade receivables or debtors problem.
Tamanna, you have one more question on the chart section from Karthik Babu. Usually, emerging company will not have good fundamentals. So, how to filter to find if it is good or not?
Okay, so emerging companies, obviously we cannot compare them with their previous 5 to 6 year data because at times they would not even have those. We can always compare them with their industry standards or how the emerging sector is doing, because if we talk about the startups, majorly startups actually they don't even do much good. They actually hardly 1 to 2% of startups are actually doing good. So we need to analyze it by actually looking around the environment, how the sector is performing, how they are individually performing, how what their unique selling proposition is.
Anyone has any query or question? Anyone? No query? So, can we close then? Or anyone has any doubt? Okay.
Yeah,
So,
not from my side, sir. Thank you. Thanks for nice session.
thank you. Okay. So, Tamanna, can you share this presentation in our group also so that people can get the benefit?
Definitely.
Okay. So, you will get the presentation from Tamanna, whatever he has present here. So, the same will be available in our this compounding fund, the premier group. So, she will share this, and she will always be with us in every Sunday session. So, anyone has any doubt, he can uh, connect next Sunday also. So, by this, can we close today's session?